Hey everybody, Steve here with IBC Global. Hope your day is off to a fantastic start as usual. In the video you are about to see, this is a video we put together for an actual client who took out a high cash value life insurance policy. However, before she started, we looked at a number of options and we were about to start a policy right before 2022 to lock in one of the old whole life insurance products with a 4% guaranteed rate. But the policy was not issued on time. So what do we do in that type of situation? We had option A, exactly what the client wanted, and then we had to pivot and look at some different scenarios. So the video you're about to see compares the old product to new products. We go through the pros and cons of both options. If you're interested in a policy, this will give you an idea of what different policies, different companies, products, and such look like. This way you can really refine your decision-making process. Hope you enjoy it. If you do, please hit the like button, subscribe for more, and we'll talk to you soon.
Happy Monday. I hope you had a great weekend. So I wanted to put this video together to provide really an overview of the Excel spreadsheet, a few detailed illustrations, and really just provide more awareness around the different options with MassMutual and Guardian. I know we spent the majority of our time on Guardian up to this point. And during our last conversation, you picked up everything with MassMutual pretty quickly. But I'm going to go through just some additional information around the different products, different options. This way you've got full transparency and can really make the best, most informed decision. So let's have some fun talking about cash value life insurance. You can tell you're talking to a true insurance nerd when someone says that. So on the Excel comparison sheet, a lot of options here, and you'll see 4 tabs on the bottom left-hand corner. First, you'll see 150K for 10 years. This provides a direct comparison just based on the 150 for 10 years of the old Guardian product, new Guardian product, and 2 new options with MassMutual that specifically have those lower PUA fees. And really what that translates to is more cash value up front. So I'm going to start with that. Before I start with that, what the last 3 tabs represent are options with the 150,000 and 200,000 per year going into a policy. And what I want to make sure that I cover here is one of the things we discussed is what does a policy look like if I pay in 150 per year? I can max fund it and it will look like everything we've looked at thus far up to this point. But then also, what does it look like if I pay in 200K per year, which will look good, but then what happens if I take that same $200,000 per year policy and I don't hit 200K per year? I only hit 150, meaning I take out this big policy where I think I can hit that number, but then I don't. Life happens. I decide to dedicate resources elsewhere, whatever it might be. I bite off more than I can chew, to use that expression. So that's what the other tabs represent with the different options, which I can go through thoroughly with you. But let's start with the first tab. So 150K for 10 years. On the far left, you'll see an option with the old Guardian product, as I know that's what we spent the majority of our time on. And I want to use that as a comparison, mainly because with that, the point of attraction was the guarantees and particularly the upfront cash value, saying, hey, my break-even point was very early in that product, strong guarantees. I like that option, combining it with the flexibility as well. So as we look at this guy here, got 150 going in, first year cash value, just over 131. What's highlighted in yellow represents the break-even point. So this is a policy where you've got the ability to pay a maximum of 150 per year, and it assumes that you do pay a maximum of 150 per year for 10 years. After that, you can continue to pay into it if you want to, or stop like this example. You can also stop earlier if you wanted to do that too. But we've got it breaking even at year 4 compared to the new product. Here's the main difference. First year, 150 goes in. You've got 125 in cash value. About a $6,000 difference, a little bit more than that. Here's the main reason why. It's not the lower guaranteed rate at all, actually, because both of these products assume the company's present dividend rate of 5.65%. Here's the key difference. Guardian's old products had a PUA fee of 5%, whereas their new products have a PUA fee of 10%. The purpose of a higher PUA fee is really so an insurance company can take more money up front and then go ahead and use that money for other investments and such. The purpose, just to actually give you the answer, that my set of details, the purpose of a higher PUA fee is meant to drive greater long-term performance. Just when you look at cash value life insurance and how PUA fees work, it is meant to drive greater long-term performance. Does not mean that it will, but that is the purpose of it. So the advantage there is greater long-term potential. The disadvantage is upfront cash value and also guaranteed cash values. It's not as attractive. But when I compare the two side by side, my break-even point is year 5 instead of year 4. So that's focusing on Guardian compared to Guardian, same product, same design, same everything. Transitioning to MassMutual. So I ran 2 options with them. Their 15-pay product, which means you can pay into it for a maximum of 15 years. However, you're not required to do that. You'll see that we stop after 10 in this example. And then their 10-pay option, which the name means that we can fund it for a maximum of 10 years. But again, we do not need to fund it that long either. So what you'll notice with these 2 products is that the company did not increase their PUA fees. To provide some additional info, the guaranteed rates are 2.5% with the 15-pay and 2% with the 10-pay. But because they did not increase their PUA fees, what I've seen is stronger guarantees in many cases with that MassMutual 15-pay compared to products with a 3 and even 3.75% guaranteed rate. And I can talk through that in more detail with you as well. It has to do with the design and lower fees more than anything. But here's what's interesting. I'm going to pull up the detailed illustrations of these as well. 150 goes in. This is the 15-pay product, which has about 129 in cash value right off the bat. The old Guardian product had 131 right off the bat. As we compare these side by side, break even year 4 in the old one with the 15-pay product, breaking even between years 4 and 5. By year 10, very comparable. The one thing I'll add though, like when we're comparing different companies and illustrations side by side, in most cases, MassMutual is going to project greater long-term value. The key word is project. And why I emphasize that is MassMutual has a 6% gross dividend rate right now. Guardian's at 5.65%. Here's a big thing just to be aware of. When we look at life insurance policies and companies, what I have found to be so consistent, regardless of what illustrations and projections show, we like to throw those out the window, is well-designed policies, really with the 4 major mutual companies, MassMutual, Guardian, New York Life, and Northwestern Mutual, have consistently delivered the strongest actual results. So aside from what the projections display, I've also seen the companies always almost go back and forth with each other. So one may display better results than the other, but in reality, you can't go wrong with any of them. Flexibility is the big factor that refines the decision-making process. But here we go, 15-pay product, year 10, similar values to the old one. But looking at the 10-pay product, in the first year, 134, almost 135, compared to the old Guardian product, about 131. So you've actually got a bit more in the 10-pay right off the bat. Year 2, the Guardian product shoots back ahead, but not by much. And by year 4, you are almost identical with respect to the cash value when I compare these two. Here's a glaring difference. You may have picked up on it already too. It may have jumped out at you. When you look at the old products, the big difference with the old products compared to the new ones is really in the death benefits. So the death benefits, less than half initially on that 10-pay policy. It will grow at a faster rate, but it starts out quite low. Comparable cash values, but much less life insurance as the years pass. With the 7702 change, lower guaranteed rates and such, really what you'll see to be consistent, the MassMutual 10-pay has the lowest guaranteed rate at 2%. The lower the guaranteed rate, the lower the death benefit. Specifically, this death benefit in this example gives us a $150,000 MEC limit. Whereas the old products, I need a much higher death benefit to get that same 150K MEC limit. So I need less life insurance, which often results in a little bit less cost and allows me to maximize the cash value component. So that's why I see a comparison here, or a very comparable outcome when I compare the old and the new. So just to recap here, as we look at the numbers, because if I'm you and I like that upfront cash value that's attractive to me, what I would look at just from our conversations thus far is this option. The 10 pay would jump out at me. However, that may not be the option I necessarily go with. And here's why, just to provide some additional awareness here. As we look at the different options, so Mass Mutual, 15 pay and 10 pay. This is it. Flexibility. Just to provide a recap or a quick overview, the 15 pay product, how we can design it with still having strong upfront and long-term cash value. You can, easily make payment adjustments one time per year, every year, without any medical underwriting, provided that the adjustment fall on your policy anniversary date. So what that means is if you started a policy in January 2022, and let's assume you paid $150,000 right off the bat, when January 2023 rolls around, let's assume you pay in only $100K. When the next year rolls around, or let's say even before the next year, let's assume that it is June 2023, and you said, hey, Steve, I only paid in $100K in the beginning of the year. Is it possible that I can throw in the additional $50,000 in June 2023 just at a random time? And the answer would be most likely not, or not most likely not, that the company would likely require some type of medical underwriting in order to accept those payments if you just wanted to add them at random. If you said, all right, I don't want to do that, I'll just wait until my anniversary date, January 2023, go back up to the 150. You could even, in this particular scenario, pay in $200K. Because you could have paid in $50,000 the prior year. We'll assume you did not. So that unused space, those unused dollars, roll over to the next year. So your maximum limit, $150 per year, plus the unused space from the prior year, or if you wanted to, you could pay in a maximum of $200. My point, I always provide a lot of extra info, and if I do too much to say, Steve, simplify it more. The 15 pay product, you can easily make adjustments one time per year, every year, without any underwriting. You simply say, here's how much I'd like to add. We make the adjustment in the back end. Your online portal is updated, and you can send the funds in. Compared to the 10 pay policy, how we design it, we can make it flexible, just like that 15 pay policy, but you'll see the upfront cash value, the long-term cash value won't be as attractive. It strips a lot of the cash value benefits just when I compare how to maximize cash value. So we designed it a bit differently with a level term rider, but here's the difference, or here's a consistency. The payments need to be made at the same time. So if it's January of each year, any dollars I pay toward premium and PUAs, all at the same time. Key difference. Very easy to decrease payments, difficult to increase payments. So I can go down each year, no problem. But if you want to go back up, that's where the company will come in potentially and say, you've got to go through medical underwriting first. They don't always require that, but they often do. The initial design has a little bit to do with it, which I can talk through in detail. But just to provide a summary, the 10 pay product is not as flexible as the 15 pay product, focusing on Mass Mutual. If you said, hey, this is my number each year, Steve, like whether it's the 150 per year, 200 per year, I know I'm not going to need that much flexibility. And if I do decrease it, because it's always easy to decrease, I'm good with it. Like I don't have to go back up, or I'm okay with going through underwriting. If that's the case, then I would gravitate toward the 10 pay. If you said, I like the flexibility to bounce up and down each year, and with the 15 pay, I can fund it for a maximum of 15 years. If you think I might want to go a little bit longer than 10 years, then that's a good option with that 15 pay product. But really the 1 time per year flexibility is the key difference. So that's what this piece really provides an overview on. To look at the detailed illustrations, the Guardian one, I know we've gone through that several times. So there's your minimum premium. Key difference with Guardian, you'd be committed to the premium plus the term rider. So if I were to just round that, it would be approximately $15,000 per year. That would be your true minimum commitment. So Guardian's sweet spot, in my opinion, is when someone says, hey, I love the idea of funding a policy for, call it 10, maybe 15 years or less. And I love the flexibility where I can easily commit to the minimum of 15 and then just pour in extra money into PUAs whenever I want. So this reads scheduled. A difference you would see though, is we would design it with an unscheduled payment. So you can add the fund if you want, not required to, the maximum of $150 per year. There's the key difference between the two when we're looking at the cash value growth. There's some other differences with their loan features and such, but we can talk through that if you'd like. Looking at the other options, so with Mass Mutual, here's their 10 pay policy. Where's the money going? There's the premium, $15K. Here's our term insurance rider. This is a cost-effective way really to raise the MEC limit on a policy. So the purpose of that term raises the death benefit, which does this. Gets that MEC limit up to where we want it. As you scroll through these, on the PDFs, I did include the internal rate of return as well, which just shows the net growth rate year over year, or the average growth rate as time passes. There's your 10 pay policy, funding for 10 years. And then the 15 pay policy as well, which carries a bit of a higher premium, not that much higher, but we're typically not able to get that down to the true 10% minimum, yet it functions very consistent or very similar to a policy with a 10% minimum premium, but we drive it as low as we can. And these values match what we saw on the Excel spreadsheet. So last thing I will wrap up with here, know that this is a lot of information, is the other 3 tabs. I'll just focus on the Mass 15 pay, just as an example, if you like that flexibility. Example on the far left, 150K maximum. Specifically, we have a $150,000 MEC limit. The examples on the right, what these represent, 200K maximum. Specifically, a 200K MEC limit. Also, 10% minimum premium of the MEC limit. So the MEC limit, that's that IRS limit, the maximum you can pay in each year. And then the base premium, if we focus on Mass Mutual, wherever I set that minimum premium, they will allow a total payment of 10x the base premium, hence the 200K per year. So these 2 examples on the left, here we've got a 150K MEC limit. You're funding 150K per year. Breaking even year 4. Looks great. Example in the middle, 200K MEC limit. You're funding 200K per year. Looks great. Breaks even year 4. Example on the far right. So here's the key on this. This is the same policy with a $20,000 minimum premium and $200,000 MEC limit. But what it looks like if you only paid in $150 per year. So I have a policy where I can pay up to $150, but or pay up to $200 per year, but I only pay $150. How much does it cost me if I don't max fund it each year? That is specifically what I'd want to see if you and I flip positions. And what we can see here, break-even point is a little bit delayed. Year 10, 1.766 compared to the example on the left, 1.799. So not a huge difference, but I do see a difference in cash value, which is good to see up front, especially when I'm laser focused on the break-even point and other pieces of this. But let's do this real quick, just to see the difference. Actually, I'm going to do it this way. Here we go. Good old Excel. Where years ago, I was talking to a friend of mine, and he's building out Excel formulas. I'm like, oh, that's pretty cool how you did that with that formula. And he just goes to me, yeah, you can pretty much do anything you want with Excel. I don't know why I got a kick out of that. Well, just the way he told it to me. Like, matter of fact, yeah, you can pretty much do anything with Excel. It's fun stuff. And I do like it just because I'm able to provide everything side by side. So this just shows the example on the far left compared to the example on the far right. Same out of pocket to you, $150 per year. But this is the policy where you can go up to $200K, and it shows what the ramifications are, the potential ramifications are if you don't do that. You just paid a maximum of $150, and if you could go back in time, you'd say, I wish I would have done $150, and here's how much it costs me as a result. If you go with the $200K option, and you're able to get $200K in really during two years, could be the first and second year would be ideal, but any 2 years of the policy, then it does make sense to go with the higher option. Just when we measure the internal rate of return, cash value performance, if you were to go 200 years 1 and 2, and then 150 a year thereafter, it would still make sense to go with this option over the 150K maximum option, policy option. That's a lot of info. I hope that you find value, and I hope that this is helpful. If you have any questions, please call, text, email anytime. We can hop on a Zoom if you'd like to go through this in more detail at any point in time. And again, I hope this helps. Thank you so much, and have a great evening.
Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.